Ladies and gentlemen, good evening. This is Christopher Aaron. It is April 25th, 2018. I'm back in the plush but not overly ostentatious iGold studios, and I do thank you for being here. If my voice sounds a little bit different, I am getting over a cold, so please excuse me. We're going to do something a little bit different today. We will look at the prices of gold and silver, the near term, but we're going to do something much more in depth this week for the price of gold, which of course is the primary market that we have to pay attention to. Gold is the leader of the precious metals still at this point, although we're noticing some attempts here by silver to change that leadership status. It's not quite there yet. So let's look at some really in-depth analysis on the price of gold, where this puts us, what to look for over the coming weeks and months as we dive right in. And some of you, by the way, have asked about my big puppy, Klaus, the German Shepherd. I just wanted to tell you that he's doing well and fine. Here he is playing in some sand dunes on one of our recent outings. But thank you, everyone, for asking about him. I'll do another video with him at some point this summer. And let's get right into looking at the near-term price action. This is spot gold that we are looking at. We are still noticing the consolidation that's been ongoing. This one is getting long. This one's getting long in the tooth, to be honest. This one is getting to be about 4 months of this price action between roughly the low 1300s and that 1360 region. We've been seeing this back and forth, back and forth. This thing is getting ready to break at some point in the not too distant future, and we just want to keep a very close eye on the direction that this breaks. And also, we have some targets when it will be breaking. We want to observe that happening. We'll look more at that in the chart coming up. Switching over to look at silver. It had a nice pop last week, and I'll tell you that caused a nice breakdown in the gold to silver ratio. If you want to go back in the archives, about a month ago, there was a video that we made on the gold to silver ratio. We see a breaking in the gold to silver ratio, and this looks like it's a retest of that break. So if this low sets up here like I'm expecting in silver and in gold over the next several weeks, we should be seeing a nice top forming in the gold to silver ratio. Let's not take anything for granted, though. Let's watch it as it unfolds. So what I wanted to do this week is to rewind and to really explain in some depth here the technical analysis that goes into this channel. And, just to start off, okay, so what's the point here? There's some people that just won't listen to technical analysis. This type of video is really not for you. And just to say, hey, is it all a bunch of squiggly lines? Are we all looking, or is there no point in even looking at this because it's all manipulated? And look, I'm someone that I believe there is manipulation in the precious metals markets. But I also know that there is merit to charting where the manipulators are coming in and also where the legitimate buying and selling in the market is coming in. And if there's anyone telling you there's no point to that, well, I would just say, just go back and look at the archives of this channel, where this channel began here in the late summer of 2015. Now, we missed the absolute bottom by about $35 here, but certainly it was a lot better to be paying attention to these technicals than those who were talking about this here being a major bottom or in here being a major bottom, right? So there is merit to following this, even if you don't believe it. And if you're even slightly open-minded and want to learn about this type of analysis, what can really work here, stay tuned. Keep watching this video. This video is free. I welcome you. There's always new things that we can learn, myself included, but this is a system that truly does work. And I have not seen anyone else present this system in this kind of way. I'll just tell you right off the bat, what form of analysis do I not do? And we'll get into what all these lines mean here in a moment. What form of analysis am I not big on? It's moving averages. Moving averages, we're talking about the current price of gold relative to the price in the preceding 50 days or the preceding 200 days, the blue and the red lines. And why am I not big on this? It's because if you just pay attention to, for example, look at the 200-day moving average. The number of times that gold sliced lower, higher, lower, higher, lower, false breaks, breakdown, another false break. How many times, and especially if you look at the 50-day moving average, how many times here has gold sliced back and forth through this 50-day moving average over the last several years? In my experience, it has no merit. In my experience, it's a rare outlier when the moving average is useful. So I don't use them for this form of analysis. You will not see me use them here. If you like to use them, please absolutely do what works for you. In this channel, we will focus on the following forms of analysis to attempt to align the odds in our favor for the gold and the silver markets. What do all these lines mean? What is happening on this massive chart here? Let's take a look at it. Let's break it down. In the center, we have the price of gold. Okay? This line right here, which is made up of many red and black segments. You can see the changing of the color. The red indicates a down day, and the black indicates an up day. In the center is the price of gold from the 2011 all-time high at 1923 per troy ounce in US dollars through the recent low at 1,045 through the present. This is the price of gold. What else is happening here? What do I focus on? On the top, this squiggly line here, I've had some people ask about this over the last few months. This squiggly line is called the RSI indicator, Relative Strength Index. And this is a study of momentum. And so this line here is showing us how far either above or below the relative price action of the preceding 14 days, in this case, this is a 14-day RSI, how far above or below that, that average is gold at the present moment. So it's a study of momentum. If you just remember it as momentum, that's the easy way to remember it. And why is this useful? Sometimes, let's take a look. When the RSI here is showing overbought, meaning above this 70 level, you can see it's shaded here green, you can see that that can correspond with important tops, right? So this signal here, if you had paid attention to that, you would have said, maybe this is not the best time to buy. And certainly enough, as gold fell by almost 50% over the next 8 months, that was a very nice signal. Let's look at another signal on the opposite side. So an oversold momentum reading on the RSI. Look at how closely that corresponded with this bottom. So these signals can, and the key word here is can, with stars around it. This signal can be useful in my experience. It's not perfect. No signal is perfect. No form of analysis is perfect. And let's look at a time where this signal really didn't work. It was right here. So look at the oversold indicator right here, pointing down to this price of gold in late 2016, still above 1325, and boom, massive $200 drop in the price of gold despite an oversold signal here. So the key takeaway here is for these derivatives, this is a derivative. Derivative of what? A derivative of the price. I focus on price mostly. So when you're looking at derivative studies, always take these with a grain of salt and always try to use these as confirming or negating indicators. Never use these as indicators alone to solely base a decision off of. What's down here below the price of gold? This is gold versus something. In this case, it's the CRB commodity index, an index of 19 different commodities and average. So we're looking at a ratio analysis. We're looking at gold versus the rest of the commodities. And why is this useful? Pay attention to this signal right here. Notice as the price of gold was falling for several years, 2013, 14, 15, a slow and steady decline, look at what happened to gold versus the other commodities. So gold was breaking out versus other commodities at the same time as it was declining in nominal prices. And that's telling you that something is happening behind the scenes. Gold is actually being accumulated despite the fact that its price is falling in nominal terms. People are buying gold more than they were buying, let's say, oil or natural gas or platinum or palladium at this point. So gold versus the CRB commodity index can be very useful ratio analysis. Another derivative, another confirming or denying indicator to pay attention to. Last thing that I have on this chart, to not make it too complicated, is volume. What is volume? Volume is the number of contracts here in the hundreds of thousands that exchange hands on every single day. We're talking about paper gold. We're talking about the futures prices, the futures contracts. Yes, but I'll tell you something. Those people who continue to say, who cares about the paper price, guys, log on to any bullion dealership, of which I can recommend one that I work with. I publish articles on their site. It's called bullionexchanges.com, and I know them very well. There's a coupon code for $10 off an order there if you want to check them out. But I'm just saying, go to any dealership and look at what price you have to pay for the physical. That price is always very closely related to this quote-unquote paper price. So I'm just saying we better pay attention to the paper price. You can save yourself a lot of money. Who doesn't want to save money? Who doesn't want to try to buy closer to a bottom and perhaps use some warning signals depending on what sets up if it's time to take some money off the table, perhaps for a number of years? Wouldn't that have been good to have an assessment about at some of these peaks? So yes, it's a paper price, but we had better pay attention to this paper price. That is, if you want to be profitable. We bring up a key here. This is a key that we use on pretty much every chart. Now, this is my own system. I've said this before, I like pretty colors. So we have a key here of all these different colors. You won't find this system anywhere else, and I go over this so that if you like to watch this channel or you end up subscribing to the premium service, which I hope you will, we use this form of analysis on pretty much every chart that we're doing, so you can get to learn the system. There is some logic behind it. I'll show you why. So let's get into it. As we're looking at this price of gold, what do I do when I'm first looking at a chart like this? And we're trying to stack the odds in our favor. We're trying to say, where are those instances here in the price of gold where we should be cautious, or where should we back up the truck and make big purchases? That's the point. We're trying to stack the odds in our favor. So let's look at this. We just drew this black line here, this horizontal black line, right? Black over here in the key for horizontal resistance in this case. And what does this mean? All we're looking at, look at how these peaks match up here. These peaks in 2012. 1, 2, 3 peaks over the course of about a year here. So what we're talking about is a resistance zone. This is an area, what is the price? Right above 1,800 per ounce. Going back, this is a level where there were a lot of sellers of gold. Now, the thing about technical analysis, the reason why this works and the reason why this is useful is because oftentimes these big sellers and these big buyers, let's admit it, we're not talking about individuals like us. We're talking about big institutions such as central banks, some sovereign wealth funds, or the larger hedge funds. Now, these big institutions, especially the central banks, they're not always so clever. They don't always hide their tracks so well. So they'll enter a market, they'll say, we're going to sell gold at 1,800 per ounce, and they just keep that order on the books for as long as they want. And so you see something like this 1, 2 times in a row that gold was sold decisively at $1,800 with a $250 decline here in the price after that. And you get back up to a third time, and you got to start asking yourself some questions here. What's happening here? These same sellers still exist at $1,800 gold. So if you were going back in this time, there is a merit to aligning yourself with what we can observe that these large buyers and these large sellers are doing. That's all we're doing when we're looking at these charts. Let's look at the opposite side of that. We're looking at a support level here. 1, 2, 3 hits on this lower support level. What do we have here in sum? A trading range. Down, up, down, up, down, up, down. Between 1525 and 1800. This is a trading range. Now what happened here on the fourth time that gold approached this trading range? Boom. Slicing through it. Now, if you go back and you listen to some of the fundamental-based analysts, if you pull up some videos or articles from 2013, when this drop happened below 1525, I was not in the gold market at this time, except as a passive watcher. Why? Because when you have a major trading range like this that has existed for 4 hits on each side, 3 hits on the top, 4 on the bottom, and then a clear breakdown, this market is telling you that a major change has happened. Call it paper, call it what you want, but you are going to have to buy the price of gold at significantly lower prices, even in the physical market, for a number of years when you see a major breakdown like this. So if you have someone fundamentally telling you, oh, don't worry about this, I'm sure it's going to come right back. Not when there's a major trading range like this with a clear breakdown. What else? On a super high volume day. We were talking about the volume, the number of contracts that were traded. Boom. Major warning signal back here in 2013 that you probably shouldn't get too hopeful on the price of gold for another several years. Okay, so that's what these types of signals can tell you, and this can save you a lot of grief, a lot of headache, and some real losses. We can't get every single point perfect, but we can stack some odds in our favor as far as expectations for these markets that really can help our lives and our investing. So we have horizontal support resistance. Let's look at a few others. We're talking about this 2016 peak here. Very interesting, matching up very close with where we are right now under the 1378 region. We can actually see, though, look at this peak coming right only about $10 above the 2016 peak. Can we see that right here back in 2014? And, oh, interesting, one more peak here just above the 1425 region here coming back from early 2014. So in sum, what do we see here? When we have multiple levels where sellers have shown up in the past, all within a tight range, we are talking about a zone. We're talking about a zone. And these sellers, and we can look at the most recent portion of the zone here, these sellers should be expected to show up in this region between 1355 and 1425, 1430 or so. Anywhere in this region, when we have multiple black resistance lines within a tight region or so, this is forming a zone. These sellers are related. There's people who bought gold here in 2013, and the next time that gold got closer to this region again, they chose to sell. Even though it didn't get quite back to where it was, they said, enough is enough, get me out. And you better believe some of these sellers were still waiting here in 2016 to get out of the gold market. So that's what accounts for these close regions here that we see in the price, these close spikes over multiple years. These are related sellers. And that's why this basing formation that we're watching here unfolding now over 5 years is going to be so significant if it breaks higher, because you're going to be talking about a massive number of people that have finally unloaded all their gold, And then this market clears all those sellers and looks to establish a new range, which in this case would be higher if, once again, if this unfolds. Let us move on. So it's interesting if we look back at some of these other peaks, for example, this peak in 2015 here at 1300. Notice what has happened here, that the price of gold has moved above this peak, back down below it, back above it, back below it, and back above it. And so there are some people, and I will come flat out and I will say this, that I do believe there's a lot of really horrible technical analysis out there. And I'm not saying that I have every single thing perfect every time, but I am saying that this system works a whole lot better than some of the technical analysis that I have seen out there that is just completely flawed. I'll just say it. It's flawed, what I see out there. I'll see people drawing trend lines in any sort of way, or ignoring major peaks. And that is the purpose of this channel, is to show you in the most clear way possible what's actually happening. So when you see a trend line like this that's being ignored, or excuse me, a horizontal line that's being ignored from a previous peak, it's telling you that this market is changing, and markets do change. There's nothing saying that a market has to stay the same forever. And so we should not be paying attention to this level, not nearly as much as we were, let's say, back a couple of years ago. So we will get rid of a line like that. Now, let's talk about some different types of lines. We're talking about trend lines now, not horizontal lines. And we're talking about trends. So a peak, from an absolute peak to a second major lower peak to another peak. If we have three peaks here forming a linear trend line, it's telling us that there are sellers who are not so much concerned about, let's say, the nominal level, but they're in time, they're selling at lower and lower levels. And so we want to pay attention to trends, and when these trends are being respected over and over and over again, and then something changes, right? Boom, trend line is broken. And we often see a retest of a trend line, and this is a place where a lot of people will get fooled and they'll get washed out on the retest, and then the market starts moving higher again if they're not paying attention to a strict analysis of the actual trends. So this was a long-term trend line, magenta color, and what I like to do is to change that color to turquoise once we have a clear broken line, just so we don't focus on it quite so much. This is my coloring system that I believe really makes things logical and clear to see. If you pause the video and I move my mouse and you just take a step back and look at this chart, it's quite clear to see what is actually happening here. A downward trend, a market that's rounding out of a base and trying to overcome some flat resistance levels here, representing peaks of past sellers. That is what we were seeing in the gold market at this time. Big breakout that we saw last year, and we're still working now on these horizontal levels in the price of gold below 1400. The primary, we're talking blue. What is our primary concern right now for gold? This rising trend line from the 2015 bottom, simply connecting the only two major bottoms, troughs that we possibly can connect. This one at 1045 and this one at 1122. And notice we had a lesser channel here that had formed, turquoise, very faint to see. A lesser channel, notice we're talking about a best fit channel, lower, higher, lower, higher, lower, higher, lower, and a final low in this channel. And notice what happened when this channel broke. We then bumped off the long-term downtrend. Boom, where did it come back? It came back and retested the upper trend line exactly, which then what happened by default when you have a broken trend and a new valid trend, this one becomes the primary concern. That's how this system works. To to someone who does not study it in depth, if that's not your thing, then it'll just look like a bunch of random lines and colors. But when you really look at the trends and the crystal clarity of, for example, this retest here or this retest, and the attempts that are being made to overcome this upper 1300s, low 1400s region, it's very clear what's happening here in the gold market and what the levels would be that would tell us if something is about to happen that is radically different from a bullish thesis. We'd be looking, for example, at a break below this rising trend line as a major signal. That probably wouldn't happen hypothetically this year, but if that were to happen next year, we'd be looking at a major warning signal, and those fundamental base analysts simply will not be on top of this. They'll be late as they were here in 2013 if something should go wrong. Let's zoom in on this basing process, bring it right in. We're looking at that here, and you can clearly see the multiple peaks, 2013, 2014, 2016, 2017. We're talking all these peaks here within $60 or so. This is forming a zone. And so once again, just to say flat out, I think there's a lot of real faulty technical analysis. You have to be very careful what sort of a system you are using and who you are listening to, because I see, and I will not name any names, but I see, and it's not just here in the gold community, but I see even in the mainstream media, technical analysis of the gold market that is just wrong, in my opinion. And we will see stuff like this. We will see someone drawing a resistance level here, matching the 2016 peaks, and saying, well, this extends back to these former peaks, therefore the level to watch is 1400. Example of this, look at this Bloomberg article just a few weeks ago. Look at the attempt that they're making here at this technical analysis. Notice this is the same trend line that I have here at my bottom and the same horizontal resistance level that they're talking about. They're drawing it as one specific level to be overcome. This is faulty. I was watching this in real time and I took this snippet from the computer because I wanted to make an example of this. This is going to mislead a lot of people. What's going to happen is that a lot of people will be watching something like that, and if and when gold breaks nominally through a level like this, they're going to throw everything into this market all at once. And I think that will be premature, because most likely when we have related peaks like this, gold will break a level and then back off again and then get ready to challenge the next level. So if you throw everything all in at once when a first level is broken, as that Bloomberg article was suggesting, you will be buying at a local peak, which will be very, very painful for several months as that is happening. So watch out for oversimplification here of these levels. This is what I believe is setting up in the gold market, a series of resistance levels that will need to become, and we will see. We will see how quickly, how much vigor gold has over the next several months as it gears up for these levels. Look, we've already seen the 2017 peak be nominally exceeded. So clearly this market is starting to chip away. It's chipping away at these overhang levels of sellers. Thank you very much for watching. This is what is happening in the gold market. Know yourself, know what kind of investor you are. If you're a long-term stacker and you just find this curiosity and you're not going to change your strategy no matter what, no matter if gold goes to $3,000 tomorrow or if gold goes down for another 20 years, if you're not going to change your strategy at all, then I say, absolutely continue with what you're doing, because different things work for different people. I recognize that. That's fine. But if you're someone that is highly invested, or you're leveraged, or you're really looking to make a return on this over the next several years, this service is published for you. It's so you can have a clear sense using this system that you've just seen today, what is happening not only in the price of gold, but also the premium service that I release comes out every week. We cover gold, silver, the mining sector, the GDX, the individual miners that we are buying and selling here, all using this form of analysis, what you have just seen. Now, we don't go into this much depth every single week because that would take hours and hours and hours. So every week in the weekly updates, you get the concise summary of where we are using this form of analysis. If it makes sense to you and you're allocating a significant amount of capital to this sector, I would say it may be worth you checking out this service to align yourself in what I believe is the most accurate form of analysis that is out there. We also do special features in this service, such as coming up this weekend, I will tell you, is our special premium members-only video. It's like this format, but we go into some more interesting topics. So, for example, this weekend coming up, there's two huge topics that we're going to be covering. Number one, what happens to silver in a stock market crash? There is a lot of assumption out there. I've noticed this, a lot of people believing that no matter what happens to the stock market, silver is the place to be. And I've done a thorough study of silver in the freely traded era. That will be presented to premium subscribers this weekend. The final thing is the myths of the Commitment of Traders report, the COT as it is called. I've seen some analysis on this that I believe is flat out wrong. I won't name names. Some analysts are very skilled in certain areas, and I respect them for their level of expertise in other areas, but I've seen some analysis on the Commitment of Traders report that I have data to support, and I will present that this weekend in the premium subscriber video. I also work with individuals by voice and by email. If you would like an independent, researched perspective from someone who does not sell the metals, I simply look out for the best interests of my subscribers. I work with new stackers all the way to those with quite large sums of money that they're looking to diversify within the precious metals sector. Thank you very much for tuning in to this week's video. I hope this has made sense. I know this has been pretty long. We won't do long videos like this every single week, but I really wanted to. I've had a lot of people asking and posting questions, and by all means, if there is anything that I haven't made clear here about this system, please post a question. I will try to answer it. I've had people asking what the different lines were and the different forms of analysis that we do here, what those were. So this video was an attempt to show that. There's a few things that I couldn't get into. For example, we cover Fibonacci retracement levels. That will have to be a topic for another day. That requires another major chunk of time to explain. There are some forms of analysis, as I said, that I do not believe in. I do not believe in moving averages. I do not believe in Elliott wave theory. If it works for you, seriously, awesome. I congratulate you. Anything that works for anyone, I think, is awesome. It doesn't work for me. And I've seen too many times where it just gives flat out completely wrong results for year after year after year. So Elliott wave, and I disagree with it philosophically, actually. You know, they claim that these waves have to move in a set pattern all the time. I think waves can move in many different patterns. So the form of a technical analysis like this, the purpose of that is to chart the many forms that these waves, higher, lower, consolidations, what form can these take? Once again, the premium service is much more concise than this, but I wanted to give people a look at what exactly is happening here behind all the lovely squiggly lines. Thank you. I'll see you this time next week.